I'm Charlotte McLeod with the Investing News Network, and here today with me is Jeffrey Christian, Managing Partner at CPM Group. Thank you so much for being here today. Great to see you.
Great to be here.
Really nice to see you, and I think that we should start by talking about February for gold. So I read that last month was the worst month for gold since June 2021. So I wanted to ask if its performance made sense to you in February. What are your thoughts on gold?
Well, I think that's kind of a silly thing for people to think about, because gold rose from 1624 on November 3rd to like 19 something on February 2nd. And then after 3 months of extremely strong increases, you had a pullback. And the increase reflected investors' concerns about the economy, and then the pullbacks reflected profit-taking after 3 strong months, and also realization that the global economy and the U.S. economy probably were not as in dire straits as some people thought.
Great answer. I think the context is really important there. And maybe you could remind me of the price range that you're expecting for gold in 2023, because I think that's probably relevant.
Yeah, I think it's very important because, we point out, our price range for 2023 is probably 1750, 1740 on the downside, and maybe 1980 on the high side. So we think that the price could come off in the second and third quarters and then start rising more strongly again in the fourth quarter of the year. But going back to your first question, there's a difference between people who think about quarterly and annual averages and people who look at, where's the price today? So there are people who talk about how low the gold price was at the end of last year. But the reality is that the gold price on average was at a record price last year. The gold price was a record $1,804. And you have these people saying, but it was down from $2,000 the week after Russia invaded Ukraine. So if you're a day trader, maybe that's important. But if you're an investor, you're at record prices.
Okay, and I think that's really important to remember, and I think because everything moves so fast, people forget to remember the long term, and they look on those, just what's going on from day to day. So let's talk about the Fed and where it's going in 2023. So I believe when we talked in January, you were expecting 50 basis points in the 2 hikes in Q1. So we got one of those, we got 25 basis points. We've got the next meeting soon coming up. So are your expectations still the same there?
We've actually increased our expectations, as has the market consensus. So we were still, we're still sort of leaning into the idea of a 25 basis point move when the FOMC meets at the end of March. The market consensus is now that might be a 50 basis point move. Actually, the market, let me stand it. There were people who were talking about 50 or even 75 basis points. We think they're off the mark. The market consensus is still a 25 basis point move in March. But the market consensus also has a 50 basis point move in May. We're not convinced that we're going to see that. We're still sort of saying, 50, 75 basis point increase in the first 3 to 5 months of 2023, and then a plateauing, and then maybe interest rates start falling November, December, but probably they don't start coming down until 2024.
So can you tell me specifically what made you make those adjustments?
Well, it's stronger economic data, basically, and also signals from the Fed. The market keeps getting it wrong by thinking that the Fed will have to change its policies to the downside, but the Fed has been changing its policies to the high side because the economy has been much stronger and will probably continue to be strong for at least the next 3 or 4 months.
Right, and you remind us usually when we talk that we can speak about the Fed, and that's all well and good, but you also have to look at the fiscal side of things. This is important, and I think you said in our last conversation, fiscal policy changes could even be the trigger for a recession. So what should we be watching there?
Yeah, I think we will see a recession at some point. Our best guess is 2024, 2025. And when it comes, it's not going to be monetary policy. They'll probably see some fiscal contraction simply because it's been so stimulative for the last 3 or 4 years and the last 4 decades. But also you'll see constraints on the supply side of the actual economy. The real economy, you will start running into supply constraints, not supply chain problems, but supply constraints, simply because we've had strong economic activity. And we're expecting a cooling off of consumer and business spending. So it's the real economy of supply and demand, goods and services, and fiscal policy that we're paying attention to when we think about when the next recession comes.
And with that in mind, there's a lot of questions going around about the debt ceiling right now. Is that something you're looking at? The debt ceiling?
Yeah.
Is that something that you're looking at? What are you thinking there?
Well, the debt ceiling is a meaningless thing, but it's important because it's there. And if the Republicans look like they're going to try to use it to extract concessions out of the Democratic administration and Senate, that could go a long way to damaging investor, consumer, and business sentiment, and it could help contribute to a more rapid decline in consumer demand and business investment, which could hasten a recession.
All right, so we've got an idea right now, I think, of what's going on in general with gold and with the economy. Another big topic in the gold market right now is central bank buying of gold. This is something that's caught a lot of attention in the last couple of quarters. So I want to get your thoughts on that. If you could break down who we're seeing buying. Do you think this is going to continue? What should we know?
Right, yeah. There's a lot of weird things being said about gold and central bank gold. One is that central banks bought 20 million ounces of gold, and it was the highest level since the Bretton Woods era. Central banks probably bought about 10 million ounces. There's another thing that, people misunderstood what they were seeing in the market. They were thinking that China might have bought 10 million ounces of gold. The People's Bank of China bought 2 million ounces of gold in November and December when the price got to 1624. They said, well, why weren't they buying from late 2019 to till November? It's because the price was $1,800, $1,900 an ounce. They don't want to buy high. Gets down to 1624. They're sitting on gold that other people have asked them to sell for them in a special account. And they say, hey, at 1624, we'll take a couple million ounces. Second thing is there's this view that central banks are rushing into gold. If you look at the 21 central banks out of maybe 180 central banks worldwide, 21 of them bought gold last year. And some of them were like 10,000 ounces, 9,000 ounces. They were like residuals from medallion programs. There were 8 central banks that bought more than 680,000 ounces. So 8 central banks out of 180 were significant buyers of gold. China at 2 million ounces, India about 1.4, 1.6 million ounces, and the other 6 were Islamic governments. So clearly, non-Islamic governments are not racing into gold. Islamic governments were buying a lot of gold last year, and I think it reflects less about their view of the dollar and their view about gold, and probably it reflects their view about the political and economic and social stability of Islamic governments.
So in your view, it's more of a story about what is happening over there versus this overarching central bank.
Yeah, when people say that central banks are rushing into gold, the vast majority of central banks are not rushing into gold. 21 central banks bought gold, 8 of them bought significant amounts. And central banks are not rushing out of the dollar. The percentage of foreign exchange reserves that central banks hold in US dollars has been relatively stable between, say, 58 and 64% for decades. And it's been relatively stable between 58 and 61% for many years now. So they're not racing out of the dollar. They're not racing into gold. It's a lot of marketing hype.
So can you talk a little bit more about how we have this discrepancy between what people think that the central banks bought and what they actually did buy? Because I think the numbers come out from the World Gold Council, I think is what most people are looking at. So where's that coming from?
That comes from their people who provide them data. And to the World Gold Council's benefit or whatever, when they first came out with their statement in December, they said, look, our data provider has said that some central bank bought maybe 10 million ounces of gold. We're not adding that to our additions of gold monetary reserves at this point because it's just a rumor, and no central bank has actually added that gold to their monetary reserves. But by January, they had shifted and they said, no, we're going to throw that 10 million ounces in, so therefore we can say that there was this unprecedented surge to 20 million ounces of gold. Yeah, the problem with the gold market is it's secretive by purpose. People don't really want others to know what their gold is. So there's a lot of opacity in the gold market, and the lack of transparency allows people to say anything they want about gold, and who's there to say, hey, no, that's not true. Yeah, and so you have, in markets, George Soros always talked about reflexivity, and the creation of our business, our research operation in the 70s was predicated on the idea that in a asymmetrical market where a lot of people don't know what's going on, if you have a better stream of information, if you know that central banks are not racing into gold, if you know that it was 10 million ounces, not 20 million ounces, you can position yourself for the inevitable reflex in the price. The price has risen because people think central banks are dumping the dollar and racing into gold, but no, that's not the case. You don't follow that trend. You position yourself so that when people realize they've been lied to again or misled, and the price comes back down, you can profit from that.
Right, and let's talk about what's going on with the dollar as well, because I think de-dollarization is a trend that I keep hearing about at least the past couple of months in 2023. So, and that has a lot to do with people are diversifying away. Maybe they're not dropping it entirely, but they want to get away from it. So in your mind, that's less of a trend than some people think.
Well, as I said, central banks have not been de-dollarizing. Russia has because they don't have to. But actually, if you look at it, the vast majority of Russian trade settlements have been in U.S. dollars. Always have been. And it has declined a little bit since the sanctions came in, but most of their trade is still U.S. dollars. So the de-dollarization is, again, it's like the commodity supercycle. It's a marketing hype that doesn't actually reflect what's really going on in the dollar market. The dollar has fallen since it peaked in early November, but it's still vastly higher than it was prior to that. Yeah, so you're not really seeing de-dollarization. On a long-term basis, most central banks would like to see a multipolar international currency regime. But the realization among central bankers and economists is that this is going to take decades to occur because you have 60% of foreign reserves held by central banks in the US dollar. And you can't move out of the dollar rapidly enough without causing hyperinflation in all the other countries whose currencies you're moving into, because they don't have the liquidity that the dollar has. And then on the private sector, you're like 70 or 80% of private wealth is in the US dollar. If you try to get out of the dollar and go into the euro or the yen or the Swiss franc or the pound sterling, you're going to be really inflating those currency prices. So you cannot move fast. I mean, we started talking to central banks in the late 1970s, early 1980s about a move toward a multipolar currency regime, opening the yuan up to convertibility. And that was 1981. We're 42 years down the road, and some of that process has started to occur.
Okay, and I feel like I'm going to open up a Pandora's box here, but we've been talking about things in the gold market that people think are true that aren't necessarily true. What else is out there that you can mention that people might be surprised to hear?
In the gold market?
In the gold market.
Well, I think that, we've seen a big decline in in jewelry demand and investment demand from the second quarter into the fourth quarter of last year. And people don't realize that. I mean, when the China Gold Association released its 2022 data, it said, mine production rose X% to Y tons in 2022. Refined production from imported concentrates and scrap rose X% to Y tons in 2022. Jewelry demand and investment demand were very strong in the first quarter and then just fell very sharply in the second, third, and fourth quarters in China. So far that we're not giving you numbers as to how low jewelry demand and investment demand was in China. So I don't think people have realized how weak investment demand and jewelry demand has been. And it's not just China. The same thing occurred in India, North America, and Europe in the second, third, and fourth quarters last year. So I think one of the big surprises that people are going to find is that investment demand has fallen. Investment demand probably fell a third last year. It's still very high at 27 million ounces, but it was down from 40 million ounces in 2020. So you've got to pay attention to the fact that because investment demand is ultimately the price driver. And investors are saying, look, we still want to buy gold. We're buying 27, 28 million ounces a year. We're not going back to 17 or 15 million ounces a year. We're still worried enough to buy gold, but we're not in that fever pitch that we were in 2020 when we bought 40 million ounces.
So the reason for the lower buying, it's because they're less concerned. It's not to do with the higher price.
It's both.
It's both. Okay.
The price is obviously one, but also, the economic and political drivers that cause investors to say, I should have more gold, have the investor perceptions have backed away. Obviously, on a political front, things are worse on an international basis and in domestic basis in the United States, Europe, China, Russia, the UK. But the economic conditions have been better than people expected.
Okay, we're going to, I think, move over to silver now, another favorite topic. And I know that you at CPM Group recently did the latest Facts and Fantasies webinar. Mm-hmm. So one thing you did for that, which I thought was interesting, is you reached out to your audience and you said, what do you want to hear about? So I wanted to ask about the questions that people wrote into you. Did they surprise you? Were there any themes that emerged in terms of what people wanted to hear from you about?
What surprised me was the quality, the high quality and the high content of the questions. If you go back to 2021, when certain groups were coming into the silver market and super hyping it, the world's going to run out of silver, the mining production is falling, grades are falling because you can't find high-grade mines, all kinds of nonsense. And people were buying into that. And when we came along and said, that's not true, we were vilified. Now you still find a few trolls, but the vast majority of the questions were very substantive, and they suggested a high level of information, that people were actually studying the silver market. We get a lot of questions from people. I drank the Kool-Aid. I bought silver at $30 or $28, thinking it was going to 50 or 750, and now I'm at a loss. What do I do? So I think that the big surprise was the high quality of the questions. They were some of the best questions we've ever been asked about silver. Really?
That's great. So everyone should go check that out. I believe it's on YouTube. You can find it. So you've told us before, when we talk about the silver price, we have to talk about investment demand. And I think we should talk about that now, just because you've been telling us about how it looks for gold. So is it a similar story for silver?
It is a similar story. You saw a big surge of silver investment demand in 2020, and then it has tapered off some in 2021-22, and it's kind of where it was in late 2022 and early 23. So you still have a lot of investors saying, I'm interested in silver. A lot of investors are dealing with losses because they drank the Kool-Aid, but there still is interest in silver. And our expectation is that it may start to increase again, maybe not in the first half of this year, but maybe toward the end of this year into 2024. Part of the problem is a lack of really good, accurate marketing. The silver investors they're licking their wounds because they've been lied to and misled so much, and they've lost a lot of money by thinking that silver was going to these high prices. So, I think that that's one of the factors that we're watching.
And if you could, again, remind me of the range that you're looking for silver in 2023.
Yeah. We wouldn't be surprised to see it spike down as low as $18 in the second and third quarters of this year. But by the same token, we wouldn't be surprised to see it get up around $28. There's a possibility it could spike higher toward the end of the year. But we think, let's say a $20 to $28 range is probably a good range for 2023. I should point out, we have this quilt chart that we do where we look at it's 9 different asset classes: big stocks, little stocks, U.S. stocks, foreign stocks, real estate, bonds, large bonds, corporate bonds. And if you look, and then we add gold and silver. Top performer in 2022 were T-bills at 4.4% increase over the course of the year. Silver was the second one at 3%. Gold was the third one at negative 0.1%, and everything else was down 11 to 22%. Silver really showed its value for a diversified portfolio last year. And we saw that in January in gold and in silver, where institutional investors and high net worth individuals were saying, what happened last year? Oh, I lost 11 to 22% in real estate, stocks, and bonds, but if I had silver, I made 3%.
Okay, so again, important context for everyone to have. I want to look at the mining companies as well, at least briefly, because you've told us before that it doesn't really make sense for companies in the gold sector, for example, to try to get really big to get that institutional money. They should be looking for sources of capital in different places, right?
Right.
So I want to check in with you on this wave of M&A that we seem to be entering. Is this making sense to you? What do you think?
I would not invest in a company that is taking profits and trying to buy other companies. It's trying to grow. The key is to grow your profits, not your ounces. The number of ounces you produce doesn't matter, and no matter how big, you could buy the top 10 gold mining companies in the world and still be too small for the major institutional investors to say, I want 2% of my portfolio in that company. Therefore, stop thinking that you want to try to get big enough to attract these people, and look at what really counts is your profits. You know, not how many ounces you're producing, how many dollars of profits you're producing, and what are you dividending out, you know, and what are you doing for your shareholders. That's the kind of company I would invest in. I would not invest in a company that wants to grow and grow and grow.
I think that's a little tricky because a lot of the time people get told, well, you should look, if you want to invest in a smaller company, look for a takeover target, right? So,
well, that's the other side of it. Yeah. I mean, you know, if you look at it, the people who have done well in these M&As are the investors who invested in the company taken over. And they get cashed out at a high premium by people who are depleting their financial resources by paying a high premium for the company they're taking over.
Okay, so takeover target is okay. That is the company
absolutely.
that will benefit. Okay, gotcha. Now, are there any tips you could give on how to understand if a deal makes sense, right? Because it sounds like we're seeing a lot of different things come up.
Well, I'm not an equity analyst. You know, we study the markets and we advise individual accredited investors on things. You know, one of the things you do is you look at it as accretive. So, you know, I actually had the highest level guy in China in the gold industry ask me when Barrick was merging with Mark Bristol's company. He said, you know, that makes sense. Why didn't Barrick try to buy Newmont? And I think it actually had, but, you know, language barrier. Barrick was suffering. It had a profile of declining production. Newmont had a profile of declining production. Mark's company had a profile of rising production. You add that to Barrick, and now you've got flat to slightly higher production. That's a positive move. And again, you're not looking at reserves, you're looking at production, but you're also looking at profitability. Yeah. So that makes sense. One of the things to look at is what's the new merged company going to look like in 3 to 5 years? Again, I'm a longer term investor. I'm not saying, oh, I'm interested in trying to, oh, this company is going to be a takeover, and as soon as, you know, I'm not a risk arbitrager. I have clients who are. I look at it as a longer term investment, and I say, what's the new company going to look like? And part of the issue is going to be who's managing it. You know, we've seen mergers where a company that's not necessarily well managed takes over another company, and the acquired company's management takes over. That could be a good sign.
Okay, I think that's really useful for investors who might be looking at all this M&A activity that's going on. As we're wrapping up, I want to go in a little bit of a different direction because you've reminded me before that CPM Group might be known for gold and silver, but you do all kinds of other things.
Right.
So I'm going to throw you molybdenum. This is a metal that has seen a big price increase, I believe, due to a squeeze in terms of supply demand. So I wondered if you could share any knowledge that you might have of that market, because I just think that's interesting.
The big moly is an interesting metal to be invested in, not through the molybdenum metal, but through mining companies. And we have a couple clients that are looking to restart moly mines. One of the problems with moly is that a lot of the molybdenum comes from byproduct copper mines. And so you have primary producers who are the higher cost end of the curve. But you look at the projected demand for molybdenum, it is wind technology, and to some extent, solar is very small, but there's some other new energy technologies coming along that for which moly is critical. And you start projecting supply and demand, there's not enough molybdenum to meet the amount of demand that is projected from the windmill industry and from other technologies. And also people don't realize, high strength steel with a lot of moly is used in drill pipe and in transmission pipes for oil and gas. So moly's an interesting thing because it is critical and in short supply for the existing energy industry, and it's also critical for the emerging energy technologies. So I think moly has a bright future.
Okay, thanks for humoring me on that one.
Yeah.
That's everything I have for you today, but are there any final points that you would leave people with?
We also do high purity manganese and tantalum research.
Amazing.
No, I think that we've covered a lot.
We have, and I think you've left us with a lot of sobering realizations, reality checks, as you usually do. So thank you for coming to talk about all these different things.
Okay. Yeah, unfortunately, I'm the guy who takes away the punch.
Somebody has to do it. Somebody has to do it. Okay, once again, I'm Charlotte McLeod with the Investing News Network, and this is Jeffrey Christian with CPM Group.